Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Monday, October 25th, 2021. And our top story today, consumers grapple with higher prices for goods and services and what investors should know. Joining me now to discuss this and a lot more is Larry Shover. He's the Chief Investment Officer for D. Alexander Capital. Larry, thanks so much for joining us. Great to see you again.
Yeah, thank you so much for having me on. I appreciate it.
We're going to talk inflation today, and I guess I want to unpack this because a lot of us feel the impact of inflation, but maybe we don't necessarily understand the definition of inflation. I could use a brush up here. How do you define inflation?
Well, there's so many different ways to define it depending on the scenario. I mean, the classic would be like a cost push. Inflation, which is really just when the economy is doing well and there's a lot of people like trying to buy goods and services. And on the other side, there's something like demand pull, and that's kind of what we're in today, where there's just a scarcity of supplies, and it's not like the demand is overwhelming, but it's out of balance or out of equilibrium, where the supply shocks that we've seen around the globe have just caused, temporary price increases, or at least I hope it's temporary.
Yeah, and you mentioned price increases. A lot of us are feeling this when we go to the pump. If we still have a fossil-fueled vehicle, we see it in the prices of lumber. We see it in the prices of food. Unfortunately, what is the impact of all this on the consumer? Obviously, it dampens or depresses the spending power, but what does this mean to us as consumers?
Well, yeah, there's a trickle down effect, and also there's a lag. That's something that we have to keep in mind. And so we didn't see it right away in food prices, but as fuel prices go up, there's just a chain reaction of how that's getting the costs are getting pushed down to the consumer. And I think sometimes companies or industries try to absorb that loss themselves, but after a while they can't and pass it on to the consumer. So there's a trickle down effect. And we saw that late last week when we got the Consumer Price Index report with regards to rents and housing and the lag there. But that's people are starting to feel the punch of that as rents increase, like everything across the board just continues to go up in price.
And how does this increase or this inflation compare with earnings or income that many Americans are earning? Has income kept pace?
They say they have, at least for entry level positions or even some middle management type positions, but overall they really have not. I think it's just really hard, and what we see with the unemployment report, how many job openings there are, but there's a severe mismatch between people looking for jobs and jobs available, and the fact that overall the prices have not gone up, or wages have not gone up to make up for the inflation that we've seen.
Larry, is there anything that we as consumers can do to make this inflation go away? Obviously, maybe it's buying less, or if you talk about scarcity, but is there anything that you and I can do individually, as individuals or as families, to lower inflation? Or is this something that we need the Federal Reserve Governing Board and others to act on?
Well, that's a great question. I think, not to be cliche, but sometimes the cure for high prices is indeed high prices. And like for me as an individual, I'm looking to buy a new car, but I'm just going to wait. I'm going to wait. I don't care if it takes a year or a year and a half or 2 years. I don't need a car that badly. And we've seen a run up in prices there, even in the used market, even more so in the used market. So I think it's just, if you can just restrain a purchase, if there's something you can do just to hold on and wait, do so. I mean, I think it's really the only thing we can do. I mean, I think this is out of the Fed's control as well. I mean, you look at interest rates now, the nominal rate, the rate that we see printed every day in the Wall Street Journal compared to inflation rates, it just makes no sense right now, because we've been, inflation rates running at levels we haven't seen since 2012. So to me, it says this is just beyond the Fed's control, but I do still believe it's temporary.
And from I want to get into, as I said, the investor's perspective in our next segment, but kind of teeing that up, any sense from economists that you talk to, others in and around the financial services industry, as to when this can be abated? Because a lot of this, if it's supply chain related, this is interconnectivity with the global community. So just because America may be back up and running doesn't mean that other continents, other countries are producing at the same rate that they were.
Right, exactly. And also there was severe weather problems in South America just in the last growing season. So that's done a lot to affect food prices. So you have like a double whammy there with supply chains and just incredibly bad weather. And so there's a lag. It's hard. I mean, I think it's just taking a lot longer than most people expected, because if you recall, a year ago, most minds were saying that once we get the vaccine going, that's going to get people back to work, and just underestimating the severe dislocations that exist between continents with getting supplies and getting people to drive trucks and get things on into the store shelves. So I think it's just going to be longer than most people expect, and I think it's going to be well into the spring of 2022.
Well, let's hope that things speed up. Larry, as I said, I need to take a very quick commercial break. When we come back, we'll talk about what inflation may mean for both individual and institutional investors. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Larry Shover, Chief Investment Officer of D. Alexander Capital. Larry, thanks so much for staying with us this morning.
Thank you.
And so we talked about the impact of inflation on all of us as consumers. Let's talk about the investor. Let's give some perspective. How does inflation impact what you and I do as individual investors, but also if we're part of pension funds, endowments, and other big pools of assets?
Yeah. So the markets aren't dumb, right? I mean, I think we as investors are basically dumb because we don't know what tomorrow is going to bring. But the markets seem to be a good truth teller or truth serum. And if the markets were spooked, overly spooked about inflation, I think we'd see just an enormous correction in the market, and we just haven't seen that. I mean, it is true that inflation is a tax on consumption on the individual level. It's also a tax for corporate profitability. That said, we just got through, or basically 85% through an earnings season, and most companies have beat expectations by quite a bit. Not all sectors. Some sectors are suffering greatly, but the fact of the matter is just keeping a diversified portfolio and trying to not predict the future, but maybe preparing for it is the way to go. Because just think throughout history, how many times I personally would have bailed out of my portfolio because of some big event. And every time it seems like the market just gets over it, gets around it, and just marches higher. So that said, try so hard not to focus on the near term and look at the longer term with regards to your investment objectives.
Yeah, really, really smart. And as you know, we're the Broadcast Retirement Network, so we're hopefully talking about longer term, although there may be some people nearer to retirement. And when you mentioned that diversified portfolio, Larry, just broadly speaking, in terms of equities to fixed income, is it still the 60-40 split that people like yourselves and investment professionals are touting, or has that thinking changed?
Well, I think there's a lot of people who would argue that that's taken change and that's old fashioned. But 60-40 might be good for somebody at a certain age bracket and a certain income level. It's not 60-40 for everybody. I mean, if you're getting into your late 50s or early 60s, that might be, something that you think about reducing. But I think it's really based on not just your risk tolerance, but your age, your runway, how much longer you think you have till retirement, and how much you need for retirement. But boy, you just don't want to get into a situation where the market goes down 40% or 50% and takes 10 years to recover. I mean, it's like that's something that's not out of the realm of possibility. I'm not saying it's going to happen, but it could. And so you just don't want to get stuck in a situation where you don't have the years to recover losses that were sustained because of overexposure. Yeah, and I'm thinking about some of the recessions I've lived through, 2000, 1999 to 2000, the 2008 recession. Obviously, time can be your ally, but it can also be your enemy. Larry, when you look at what the Federal Reserve has communicated, potentially raising interest rates at some rate, we don't know exactly when that's going to happen. What's your reaction to that, and how the markets are kind of imputing that information? Because as you said, optimistically, the market just continues, and earnings seem to be, fairly decent. Yeah, and as the long rate, and what I mean by that is like a 10-year out to the 30-year yields, when they start to go higher over the past 6 weeks or so, we did see the equity market wobble a little bit, but it didn't correct, and in fact, it kind of looked the other way. So, the Fed has made it well known that they're going to start tapering as soon as next week. No, I'm sorry, November 3rd or in December, and probably put the first rate hike in middle of next year. But the market seems comfortable with that. In fact, the market's gotten ahead. The market's already priced in 2 rate hikes by the end of 2022, and the equity market has not really the market's absorbed it. And so that said, it's one of those things where the market somehow feels like they're comfortable with the higher rate regime, but also realize that inflation might be transitory. And with that, there might be an inflection point where we'll see long yields start to go back down after the announcement is made and the market becomes comfortable with it.
Larry, we often, when we talk about the stock market, we think about the Wall Street, but frankly, there are stock markets all around the world. When you look around globally, London, other places, how are they doing comparatively to the U.S.? How do they react to the Fed's conversation and these supply chain issues?
Yeah, I mean, I feel like the globe is running on one cylinder right now, and that's America and also Canada, like North America. Asia, especially the emerging markets, heavily tied to the dollar and interest rates. So any kind of sharp rise in rates is not really good for emerging markets. Although I'm throwing a blanket coverage on our emerging markets, there's many of them. And the Eurozone, has made progress, but still has a long way to go. So I'm not suggesting that they're great values to buy equities there overall. I'm just saying that we seem to be so far ahead with regards to recovering and economic growth than both Asia and the Eurozone. And it's going to be really fascinating to see what happens in 2022 because we've come so much further than the other two major economies.
Yeah, well, you're right, and you're only as strong as your weakest link. And I'm not calling out these other stock markets or these other economies, but we're all kind of tied together, and that's the lesson here. I mean, we've been talking about a global economy for decades. Larry, I'm going to have to leave it there. Really great conversation about inflation. And look, we look forward to having you back on again very soon.
Thank you very much, Jeff.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.